When Matt first joined us,
not this.
He used to come up with some sayings, right? And I called them Yasin-isms. And then when it got to I think it's Christmas 2019, we thought for the party what we'd do is we'd print some off and we'd put them around the room so everyone can have a laugh at the Yasinisms.
I can't believe you still got that document.
It took me a while to find it, but here, Matt, this is only a list of 14 of them which were around at Christmas party. Michael, I'll pass yours over now. And can't even get it.
Welcome to the Property Funder podcast. I'm your host, Michael Dean. You can find me on the internet at property_funder. I'm here with Andrew and Matthew. Good to see you both. Andrew and Matthew, they've both been on the podcast before. Andrew is Andrew Robinson. He's the CEO of Arc & Co. Matthew is Matthew Yassin, who's the managing director of Aquilae Capital. Did I say that right?
Aquilae.
Aquilae.
Yeah.
It's always a tricky one. Matthew was on the podcast with us last summer, I think. So slightly different setups. We've just been having a laugh about how when Andrew was coming on, he was one of the earlier podcast guests. So it was in his attic at home with the sun, I think, shrouding half of his face, and the other side of his face, sort of half in the darkness.
Blinding people with the sun on my forehead.
You should have let your hair down that day.
Yeah, I was trying to get the wig on, but they wouldn't.
There seems to be a recurring theme because we came to visit you, didn't we, in May, and we went up on your roof terrace at your offices, and I mean it was pretty hot and sunny all summer. But
I use it as a tactic, don't I? So if you're sat opposite me, I can blind you. And
the sun always shines at Arc & Co, though.
Exactly, the sun's always on Arc & Co.
It's a great roof terrace, I've got to say. So good location. Start with you, Matthew. Since we saw you last summer, what's been the latest? How's business going? Everything going good? Bit of team growth, bit of consolidation. What's the update?
Thanks, Michael, for the invite. It's nice to be here alongside Andrew. It's good to see you again, by the way.
Good to see you as well.
The update from our side at Aquilae is the market's certainly turned a little bit, I would say. It's become a lot more positive in the right way in terms of managing deals and business and things like that. It's slightly harder. I think both on the lender and the advisor side, it needs a bit more time. It needs a bit more conscientiousness. It needs a bit more approach to actually get the deal over the line. But as a business, we've successfully closed, I think it's since last summer, probably about 40, 43, 45 deals on the structured side. Our average loan at the moment is just under 4 million. Which we're quite proud of, and you mentioned that we're hiring people. We've brought 2 new staff on this week, 1 administrator, 1 head of client partnerships. So we'll be looking for brokers probably in January. I'll be speaking to Andrew about that.
Right, see who I'm offloading.
Yeah.
for those that don't know, but Andrew and Matthew were working together a few years ago, and Andrew's Arc & Co has been an incubator for a number of very successful now independent brokerages. So yeah, certainly a great place to start your career. Andrew, since the sort of 2.5 years since we last had you on the podcast, I guess a lot of water has passed under the bridges, so to speak. But Arc & Co continuing to plough on with great success. You've relocated the offices. You've got the partnership with London Belgravia, LBB. What have I missed?
Nothing, but I just want to take a pause there because I'll come back to where we're going with Arc & Co in a minute, and I want to talk a bit about me and Matt.
Okay, go on.
Good idea.
Make it a bit lighter.
Go on, let's go.
What I did is I printed something off. So
let's go.
When Matt first joined us,
not this.
He used to come up with some sayings, right? And I called them Yasin-isms. And then when it got to I think it's Christmas 2019, we thought for the party what we'd do is we'd print some off and we'd put them around the room so everyone can have a laugh at the Yasinisms.
I can't believe you still got that document.
It took me a while to find it, but here, Matt, this is only a list of 14 of them which were around at Christmas party. Michael, I'll pass yours over now. And can't even get it. So what we got here is the Yasin-isms quote book, and there's 14 of them. It starts with the first one I ever heard. So when Matt joined us, he's a very experienced broker, and he came in to strengthen up the advisory side. And literally his first day, and it says, and he goes, bloody hell, this inbox is filling up faster than a glass of water. And I looked at him and thought, oh, here we go. And then he keeps on going on. But we can read some of them out now, and I do want to know what he means by them. But, someone's here, number 10, shy boys get no sweets. And the whole office, there's 20 people in Ark & Co looking around and say, who's this guy? He's just turned up, and shy boys have got no sweets.
Is that right, Davina?
I can't believe you got these still.
And he says, well, I thought it would lighten up the mood a bit. He says,
14, brilliant.
yeah, exactly, 14. He's probably talking to a lender. He says, don't pack the tent away too early, just in case. And, wait there, what else? Matt, you must have some favourites on there.
To put some context on this, Michael, so I like to lighten things up when I'm talking to both clients and lenders, and in my own spare time I do write a bit of poetry, so it's kind of bringing in a bit of poetic justice into the finance world.
Yeah, number 3, if the cows need feeding, well,
give them some grass.
No, wait there is one here. Oh yeah, if you are hungry and you've got something in front of you, eat it very, very quickly.
That's an offer from Avamore, very good offer from Avamore, that I said to a client, look, don't count too many chickens, otherwise they're all gone.
So some of these, I think some of these have the look of Polish sayings that maybe didn't translate brilliantly.
Yes. Yeah, and we both know what they are. Yeah, Andrew and I go back a long way, and I'm glad you got those, actually.
This is brilliant.
It was
Thank
good.
you.
We had a bit of a laugh in the Ark & Co office, because I was asking around trying to find this document. And when we pulled it up over the last few days, a few of the guys, Gareth and that, couldn't believe we've been rehearsing them all week.
Have you?
And I was this morning, I was looking at them, and they were just making me laugh so much. But I think you could kind of picture it. You got an office of 20 people. New person turned up. He's quite well known in the market, and he starts with these sayings, and everyone's just like, "What is going on here?" So I just absolutely loved it, and the Yasinisms will live on forever in the Ark & Co. Yeah.
Well, on that bombshell, I'm going to leave that dog to sleep.
Very well said, Michael.
For those that can see it, we're going to. I think Davina, we'll get that off Andrew, and we'll be putting that in. That'll be putting that on the show notes.
Yeah, he's got his trademark on it. So
That's it. Yeah.
to get his permission on there, but they are classic.
Right.
So,
I'm not sure where to go from there, but
Yeah, you caught me off guard there, Robin.
there you go. That's the best way to do it. Isn't it? Element of surprise.
So how are you going to get your own back now, Matthew, on Andrew? So
Well, when you ask me another question, I've got a few things to bring up.
Yeah, well, I think a good time is probably to talk about us working together, because I can't remember how many years we had COVID in it as well, but we had some great experiences, and at the time it leads to Ark & Co transition, and people which have joined Ark & Co left, moved on. Matthew just joined when 3 or 4 quite well-known people just left, so there was a lot of change going on within Ark & Co. And then we kind of built it back up, didn't we?
We did.
And recruited a lot more. Matthew brought a different dynamic to the team, and we had some fun times.
We had some cracking times, and even before I joined, Andrew, Ed and myself flirting with the idea and MIPing a few years in a row, a bottle of wine or two beforehand, but the right time came. I joined Andrew's business, and I thought it was an excellent place to get accustomed to the finance market, and I do recommend Ark as a superb place to certainly learn your
You
trade.
don't need to recommend. You need to recruit yourself. No?
I'll do that. Don't worry. We've got our own strategies and philosophies.
Hopefully they're different to ours.
I'm wondering what Matthew's, the Yasin-ism for recruitment, or the low hang. There must be a low hanging fruit Yasin-ism.
Well, that's it.
That's probably number 12.
Here at Aquilae, we got the Yasin-ism. We like to concentrate on the low-hanging fruit to get going. And don't worry, there'll be plenty of strawberries to pick.
Yeah, on the bush.
Or it might be the best fruit is not always the lowest hanging one, or something like that.
Something like that, yeah.
Oh my god! I think just on that, it links into is from an Ark & Co side. When Matthew joined, the market changed massively. Say 2019 onwards, I think if we fast forward quite a bit, I think the advisory market is really at a crossroads of where it's going now, and you've got the mainstream, development finance especially, and bridging is very visible, and it hasn't. The development finance market hasn't changed a lot, like as in the providers in there. There are a lot more bridge lenders in there, so you've got to look at, if you're a client and certain lenders or banks, why are we still using Arc & Co? What are they giving us? Where's the value add? Right, so you've got to be looking at advising and adding value in different ways. So that's just on the development side, but then it's the kind of products that are evolving in commercial market. The refurb market is really picking up, as we spoke about before. So it's really about, you've got to focus on how you're going to keep on evolving and how you're going to keep on adding value into that client chain. Otherwise, if you stand still, you're probably not going to be around for much longer. So it's a very, very interesting time in the market on the advisor side, and one where you cannot stand still at the minute.
Yeah, I think speaking from a lender's perspective, like the world is getting, the world is becoming increasingly commoditized, and I think what we're going to see over the next 3 to 5 years is, in this world of AI, I think that processes on the lender side, and obviously feel like we're at the vanguard of that with the technology improvements that we're bringing into the business, and a lot of the operational efficiencies which we're identifying where we can effectively streamline huge amounts of that. At the end of the day, whatever we do is going to get copied, because it's not like you can apply IP to that, and it's the same, and in some respects it's the same for you guys. So I think it's going to become increasingly difficult to differentiate yourself as a lender, but that then kind of creates even more of a need for advice. If you liken it, I was sort of talking to a lawyer friend about it today, and I think increasingly what you'll see is that AI is going to take over the role of conveyances of people who associate. The number of associates are going to need to do drafting and sort of bog standard DD is going to go down, because effectively they're going to have the tools to do that much more efficiently. But the one thing that I don't think is going to go away anytime soon is the need for really good quality advice from seasoned professionals.
Yeah, and it will get more, and Matt will be on that. He'll probably say the same thing with it. Where if you look at AI and you look at, say, the development finance market and commercial market, with regards to modelling. Right, so one of the first things, if you're looking at financial modelling and adding value in that way, a lot of it can be achieved through AI programs now. Right, so where before people trying to teach me Excel was not easy. Right, I'd probably
he's laughing at Excel. That's what Philip's there for.
Yeah, exactly. He built a team around
I bet he did.
So what you got with that is you've got all of like PowerPoint, Excel, all of these things. Right, if you put them into the advisor market, you can really speed up and add build on your kind of value and quality you can give that client. So you've got to be smart in how you do it. But the funding market, from your side, but the funding market is a massive crossroads of where it is if you're looking at banking funding, private debt funding, or the credit markets, and with interest rates coming down. So you're in a huge crossroads of the banking market and the capital ratio requirements required there, how they're funding debt platforms and back leveraging or loan on loan, and it's all evolving, right? And so more I would say, I don't know the figures, but I'd say the massive growth market is through the private credit markets, and the banks are accessing the real estate market via funding those, so it's not affecting their balance sheets more. And a value add would be in the market from an advisor's point of view is how you access those private credit markets and how you promote, how you evolve with them and add value to your client that way. So I think it's a very difficult time in the finance market at the minute, I think, but it's a very interesting one, because if you're on it and you evolve and you grab it, there's a lot of opportunity there.
Yeah, I wouldn't disagree, actually. I think the role of the advisor is much more in a spotlight now. The days of putting a bridge to 3 or 4 lenders and getting it banked within a couple of weeks, they're sort of numbered now, because, as Andrew said, there's all sorts of different sort of structured deals appearing on the real estate side, and if you don't understand the asset class, or if you don't understand who you're putting the finance with, and if you haven't got access to the private credit side of things, then you're going to struggle. And we're seeing a lot of clients being passed around the market, perhaps with a broker that's tried to do something but doesn't really understand the nature of the deal, and that's creating more work for people like ourselves. But I think that's where you differentiate between the two. I think any broker entering the structured market now actually has to understand what they're getting into, as opposed to taking orders and doing deals, because it is about advice now. And both Arc & Co and Aquilae are founded on giving advice, and that's very important.
I think it's an important point. He's got his own business, Aquilae.
Aquilae, that's fine.
There you go, got it. Well, close enough, aren't I? But the how you build a business and build a team in the advisory, it's tough, right? And you've got to get it right. And I think it's evolved. What Matt just said there is about the type of people you bring in. And so the people that are suffering are the younger trainees, and smaller advisory firms they can't take so many of those on your balance sheet, right? So you're going to have the gap of the skill set really from people, and we only take 1 or 2 on maximum of trainees at a time, and we're a team of 18-20 people, right? So smaller ones that don't want to carry it, so you're going to have a bit of a gap with younger people, which is quite sad to see on there. But I think with regards to if you've got your own business, what's the point of having your own business if you're not building value? Right? And how you generate, so Matt's taken people on in originations and partnerships. He'd say more maybe about that on the strategy, but you have to deliver. It's no point just having 20 desks, 20 people doing deals. That's very 20 years ago or 10 years ago. You've got to have everything around you. You mentioned before a partnership with LBB. You've got to have origination channels like a proper business come in. You've got to have a very strong brand, right, and what it stands for. You've got to invest in these things as a proper business. So advisory is becoming more professional with everything around it. It's becoming a proper business, but it's got to be run like a proper business with all of the attributes to it. And that's what delivers the value. I think in our market, a lot of people think they can start a business, put a name on it, and just go and hire 10 people from other brokerages and not offer anything else. That's dead. And most people, that's a very short-termism, because they just want more and more money and it'll just blow up. You've got to build an advisory platform that offers different things, and that will attract people. And younger people also need that support. They don't find it as easy to originate from what we used to do. So you've got to have a lot of things, infrastructure around you to build that business.
Yeah, I think there's a few very good points that Andrew made there. The branding of the advisory shop, if you like, is quite important now, because professional reputation is a big thing, and lenders want to see things packaged up correctly. Where lenders want to see proposals sent to them correctly, and I think what Andrew made a good point about advisors there was the days of sending a load of attachments to a lender and hoping a deal goes through. They're gone. You've got to present it correctly. You've got to do an analysis with the client. We've got some internal systems that we do our own internal cash flows, appraisals. We've got branded documents that we send to lenders. So we actually do the work. So by the time we get the deal and we've got some figures to show a client, we actually know what we're going to do, as opposed to hoping for a loan against an asset, but you don't really know what's going on. A good example of that is there's a lot of different types of assets on the market at the moment. There's a lot of lease-on-lease businesses. There's a lot of hotels, trading businesses. Data centers are appearing on our radar. These types of assets have got 7 or 8 different types of values attached to them. They've got all sorts of different ways of approaching the funding model. And if you don't know how to break that down as an advisor or as a brand, you could put yourself at risk, especially in the type of markets that you should be looking for funding for those sorts of assets in.
Well, you're talking about different asset classes, right? I can imagine both of you have probably played paddle at some point in the last year or two, and these big paddle centres are now becoming very investable, and people are trying to raise money for them. And someone approached me about it, I don't know, a few months ago, and and said, "Oh, how would you, where would I go to where should I go for funding on a paddle centre?" I said, "Well, look, fascinating, not something that we can help with, but I think obviously sort of putting my valuation trading hat on, and I said, look, this is a trading business. You would value this in the same way you'd value a hotel or a hospitality business. The thing is that if you went to a kind of spray and pray merchant broker, they would send you to three of the usual suspects who wouldn't understand the product, or you'd get terms, you get a dip, but then they'd appoint some valuer who'd have no idea how to value it. And the deal will go nowhere.
But that goes back to Andrew's point, where the whole industry is becoming a little bit more professional. So, and that the onus actually is on BDMs now a little bit, because if the advisory side is becoming more professional, more clued up, much better presented, and just raised its game, I think on the lender's side, some of the BDMs and things like that also need to raise their game, because as an industry, Andrew said, it's moving forward, and it's moving forward from brokers in the back of the room to being a professional structured finance industry, which means that everything needs to be done properly. People need to understand things, and the BDMs need to understand the deals as much as the advisor, and the lenders need to understand that perhaps opening up a vanilla proposition might be a good thing in today's market, because the vanilla deals aren't really there anymore. Development, it's a difficult part of the market, and unless you've got significant equity in any development deal at the moment, I'd struggle to see if the numbers fit. I
think if you go back to what you said at the paddle example, is a lot of things have changed right in the last 5 years around operating assets and how it is. And if you're looking at a broker, a point of view, advisor point of view, then they've got to start thinking, what are these different asset classes? What's the problem we have to overcome? Paddle, what you said there is it's an operating business basically, right? So how do you underwrite that? And then you go and speak to certain lenders and saying, look, it is an operating business. What are we looking at here? And you're trying to develop a funding package, right? So rather than taking this is a product from a lender off a rate card, you're developing a funding package for that type of asset. Now, going back to what I said earlier, that's a change in the funding market. So if you've got a bank or bank-led market, they're very fixed with what they can offer.
Correct.
And not very hard. Whether you've got the private credit funds, you can pick up the phone. We've got this new thing called paddle. And you can what's paddle, put the phone down or whatever, but you can start to explain it and understand it and build up a case, right? And that is where you're adding value, and it even goes back to offices, right? If you look at office, it's not a standard 5-10 year leases. People want the flexibility. People need to stabilise them. So if you're looking, if it's very easy to underwrite a 5-10 year covenant, but if that's completely gone and that script's gone, what you've got to look at is their business plan, their operating plan, and then try and work through it with the lenders. So it's all these things, how the market is changing from an asset class, but also what the funding is offering as well. So that's why I said it's about an interesting time in the market. There's a massive crossroads, because you're going from just delivering bridge lender terms to advising and structuring debt or equity into a deal.
Yeah, I mean, very good points. I mean, if you look at the commercial market, for example, yields are quite wide at the moment against value. So anybody with a highly leveraged portfolio within the commercial side will find it hard to find the finance to either refinance or purchase it. Yeah. So what Andrew's point was, some of these private credit funds can go beyond the binary model of classic loan to value loan, classic valuation against MV1, MV2. They can look at the assets for what they are, what they're achieving, the yields that they're generating. They can see the cash flow can quite comfortably service the loan. It's just that their binary criteria doesn't allow them to execute the loan. But some of the other lenders, the outlier lenders that are coming into the market, are able to do that now.
Yeah, I mean, we've seen a lot of what I would call traditional, private equity real estate funds effectively go into the debt space. Partly because they don't fancy the returns on offer at the equity level, but they're sort of thinking, right, well, I can get if I have a subordinated piece here, have a bank line that sits at say 60 LTV and then do the top 10 or 15% of the LTV stack, they can make 12-15% IRR on that, which is roughly what they would have been targeting anyway.
And it could be no risk. I mean, if the yields come in a little bit on the value on the commercial side, then within 5 years you're at 60, 65 anyway.
That's right. Yeah, I mean, it's funny when we talk about 10, the 5-10 year leases. We've got a commercial investment not too far from you in Godalming, and we're actually talking to a vet. The vet doesn't. We actually only want to give them a 5-year term certain because we want the option of redeveloping the site at some point in the next few years. They're turning around to us and saying, look, because of the cost of the fit out and the investment they've got to make into the space, they won't sign it if we don't give them any less than 10 years. So it's quite perverse how it's sort of playing out. But just talking about the commercial side of things, you're talking about optimism, and I'm assuming that some of that optimism is from the commercial market.
Yeah, I mean, the optimism stems from people wanting to do business. There's a lot of money in the market that's ready to be deployed, and for the right deal, there's plenty of options. And for the right advisor who can spot the right deal, there's lots of options as well. And that comes from experience, identifying opportunity, doing a bit of an analysis before it goes to market, understanding where you want to actually spend your time, because in our market or in our world, there's plenty of things to look at. But you've got to choose the right things to take forward. Otherwise, you may spend a lot of time on something that's not very productive. So
the clients have pivoted as well, right?
They have,
because most developers were standard resi developers, which is quite vanilla, right? And there isn't much margin, and there's a lot. Resi development is quite risky at the minute, because the sales are quite long, and it's a volatile market. Many things up front on legislation that can stop it, as well as and planning. But the commercial market is what happens. The buying price, the land or the asset value is shrunk massively. It's good value. So they've kind of retrained themselves to look at different asset classes, understand how they're funded, and understand how they can monetize them. So that shift has kind of been happening the last couple of years and starting to kick through. And you're seeing it now with the lender market, where a lot of people are launching commercial products or commercial refurb, commercial bridging. Right? It's accelerating it. And when you get liquidity in that sector, which there's more of it now, that's an interesting time.
Yeah, I guess the residential market has been, the residential development market has been a bit more under pressure of late. It's ironic actually, because the space that we operate in at Avamore has actually, I think, been, I wouldn't say untouched, but I feel like that it's adjusted better to the new realities, because if we're say doing a 4 or 5 unit scheme, the land values being what they are, you can generally get some sort of vendor finance or some sort of deferred payment structure with a vendor, where you've got a vendor that they haven't maybe realigned their price expectations, but they are able to leave a bit in, and the amount that they've got to leave in is not such a large amount that's going to essentially make a difference, going to be a problem for the deal. I think when you get to see these larger schemes, the 100 unit, 200 unit flatted schemes, that dynamic doesn't always work, or that amount of deferred payment isn't going to be enough to kind of make the numbers stack.
That's the market's massively changed as well, because it's become more of a operating model, right? So the living sector, as everyone classes it as, is really liquid, right, on a big scale, as long as you can get through gateway issues, etc. But it's not really for sale. It's for retention. It's for retention. It's for operating. PRS, student, all of that, right? And if you look at inner city models, most people don't want to spend 700 grand on an apartment, right, as a first time buyer. So they'd rather live in an operated model with, like co-living scheme, where you got a cinema or some games room in there, what they're used to from university, from the purpose-built student, moving into, say, London, Manchester, Birmingham, etc., in those branded developments. And that's how, so the high-rise flatted schemes are mainly operating business assets now. And housing out of town is what they do. And what you might find is people might do well working in a city, for it doesn't have to be a city, but in a town or whatever, and then they might buy a place, a house, in the countryside, right? And they might still live in, and that's so you're getting people in their mid to late 20s, which probably are doing that dynamic where it used to be people, people with young kids that might travel in a few days, stay in London, and then go back to their family home. That shifts. It's a big shift that's gone, which has changed.
Just going back to kind of advisory, you talked about being able to spot a deal for a client. To what extent do you go to when it comes to originating deals for clients? Are you trying to maintain relationships with agents, for example, in certain niches that you've got clients who've got actively looking for deals and trying to get into those deals early? Or is it still quite reactive?
No, I think one thing you learn through experience, and I think Andrew knows this as well, you don't need to fight for deals. You don't need to run for deals. You don't need to do anything for deals. As long as you've got a good network. And we work at Aquilae, we work with some nationals that look at property management. We work with quite a few lawyers and quite a few professional introducers. So the network's all there. One thing I've noticed, though, in my time in this business is the more you say no to somebody, the more they want to work with you. For example, we've got a portfolio of developments that we're talking to a developer, and to be honest, I don't really want to take the deal on at the minute, and I keep saying no to him because I've got my own reasons, and the more they want to work with you. So it's a turning point in every career, I suspect, that when you start something off, you want to do everything. You say yes to everything, and you try and do as much business, whether you're a doctor, a broker, whatever, in the initial few years. But once you come to a sort of a mountaintop of your career, you understand actually your time's a bit more valuable, and by then you would have had a network. By then you should have a good reputation if you're good at what you do, and by then people know that they'll come to you to do some business. And I think to answer your question, we're not reactive or proactive, we're assistive with a client. So if a lawyer comes to us and says, look, we've got a guy who wants to build a hotel, great, does he own the land? Yeah. Okay, has he got something between his ears? Yeah. Okay, we'll sit down with them. And here's an Yasin-ism for you. There'll be another one as well. Between ears? There'll be another one.
Not knock anyone.
No one's here. And then we work out, do we want to spend time on this? Because some of these deals do take a lot of time. And B, whether we want to take it forward from the professional reputational risk that we take going to some of the credit funds or going to the banks with some of these particular deals. So that's how I would sort of answer that question, Michael.
I think there's different ways of looking at it. Is younger people, generally less experienced people, they just want to give things a go, right? And as you get more experience, you can see if a deal, it's not about, it's too small and not worth your time working on it. It's whether it's going to happen or not, and whether they're serious. If they're a developer, have they got the right experience? Have they got the right balance sheet, right team, all of that kind of stuff. So you can if you've got more experience, you can see what deals are real and not. I would say on origination, you can indirectly originate by educating. Right, so talk about market trends. So you could go to an agent, and you could talk about. A lot of them might be behind the times. Sometimes they might see finance as a blocker to get their deal done, especially with agencies. Right, they don't really like finance like it, but actually it can be an enhancer in certain ways. And you can educate them about, okay, we've just done this office, and it's got 1.5 year lease left on it. It's got an asset management program, whatever. And you give them examples of deals you've done, and it gets their cogs, whatever's in their mind.
Yeah, if they've got something.
If they've got something in there, they're thinking, oh, right, we can do that. And it can actually stimulate deals in the right way. So if you educate people on it, rather than just sitting back, waiting for a deal to come in, look at it and say, that's no good, right? Then you can get good deals quicker and, generally get a higher hit rate.
This podcast is sponsored by Avamore Capital. Avamore Capital is a development and bridging lender based in London, but lending all over England and Wales, lending on projects from £250,000 all the way up to £25 million on bridging, development, refurb and part complete developments. Please visit www.avamorecapital.com to find out more. Are you guys surprised that there aren't more partnerships between commercial real estate agencies and as in independent ones and independent brokerages?
I think it's a good transition period, really. The big guns, JLL, CBREs, Colliers, they all bought debt advisory in-house in the last decade. The smaller ones, some of them do have them, but they do have partnerships, maybe not productive ones. And I sit there having conversations. It's and if you have an agreement with an agency, right, to send the finance to it, it's very easy to sit back and just wait for our buyer and a referral coming in. It's only as good. It's like any partnership and marriage as whatever effort you both put into it. So if you go in and educate them again, talk about stuff, maybe staple debt stuff, whatever it would be proactive on it, then you're going to work it a bit more. And I think what will happen is you'll get more solid partnerships with more SME type businesses, which gives them the firepower. So if you look at JLL, CBRE, they're all massive organisations. And when you've got an SME kind of size agency, or with businesses our side paired together, you got to play to your strengths. And your strengths are, hitting that deal, giving it the manpower, giving it the education, the knowledge, the effort, and you can use that as a competitive advantage against the big guys. Right? And that's what I find. That to me gets me going.
Yeah, likewise. Likewise, and I think it's not always about identifying a lender that will do a deal, because the irony is you could send the same deal to a lender, and they may do it with one and they may not do it with another. So I'd agree with that. You've got to play to your strengths, and also just stay in your lane. There's certain things that you shouldn't be doing, we shouldn't be doing as a business, and I'm sure Art probably shouldn't be doing, and they don't, and we don't. And if you concentrate what you're good at, then generally you'll find your relationships will grow naturally that way.
What shouldn't we do?
I'll tell you afterwards. Remember MIFIN 2019?
No, I can't remember actually.
What is it? Sun Tzu Art of War. When your enemy is making a mistake, do not interrupt him. That's
keep walking.
Let sleeping dogs lie.
No, it's just in front of you. Yes.
Yasin-ism. Let sleeping dogs lie.
Let sleeping dogs lie.
But I think it's I'm talking quite selfishly about myself, but what stimulates me is exactly that comment where you've got big guys, JLL, whatever. They're very huge organisations. They're very siloed in their teams, and they lose the entrepreneurialism, the drive. And for me, taking those on and winning business really it keeps me motivated. And it's such a, I love it when people are walking around moping and thinking that it's tough out there. You know what? It'll always be tough somewhere, right? And you've just got to find a gap and you've got to go for it.
Yeah, there was someone was whinging online about it. I think we were talking about it with Marcus actually. I think he brought it up. Someone was whinging about, I wish there were some easy deals. Like, you're in specialist finance, of course there are no easy deals.
Yeah, see that's like Andrew. There are no specialist finance easy deals. I mean, why are you in the industry if you want easy deals? If you want that, then look elsewhere. And especially with some of the money that some of the advisors get paid. You can't pick the best apples without climbing the tree. The nice shiny red ones at the top. So I think it goes hand in hand, and I agree with Andrew. When it's rainy outside and cold and windy, that's the best time, because that's when you can show your skills as an advisor. When a deal goes through quickly and easily, yes, everyone's really happy, but it's not ideal because you don't learn as much. And even some of the bigger deals that close, I had a client a week or two ago, we closed quite a good deal, and I said, how are you feeling? He goes, well, I feel like I've just divorced my wife or something, because the deal's not there to be spoken about, every day. So it's a strange industry, because you've got relationships with clients, you've got relationships with lenders, you've got relationships with yourself as well. How do I approach this deal? Am I going to do the same sort of job as I did on the other deal, and all that sort of stuff? So I don't know, it's hard to put into words, but brokers moping around, moaning about asking for easy deals, I think that's a bit That's a bit cheeky, really. Because
why don't we use that time to talk about team then and type of people? Because I think it's a good point. Is advisory brokerage broker is not for everyone. It takes a certain type of person. So I've built teams, lost teams, rebuilt them, and keep on going. You're building now.
I'm building one. We've built one together as well. So it is.
What is it? What are the traits you're looking for? Yeah.
To be honest, as long as somebody can use their initiative, right? That for me is key. Ask questions. There's no silly question. The only silly question that is asked is the one that hasn't been asked. And always reread your emails before you send them, because those menial mistakes, although they're so small and it doesn't really matter, over time it does matter. And over time, if you want your reputation to get better and better and all that sort of stuff, then you've got to just wipe the dust off the desk, if you like.
How's it going to be? You're building up. I'm asking him the questions.
Yeah.
But you're building up the team. You want to get big. I don't know what your plan is with that. But say you do. How are you going to shift your business dynamic from yourself and your partner to build a team? What would be your approach? So
first things first would be the mentality. Okay, you need to open up your mind, because advising it can be a lonely business. You generally go hunting, whatever you find, you eat and you kill, and you're happy that way. But Aquilae has been always an open business, so there's always been deals moving across the desk. No one's been really feeding themselves. It's always been a pooled approach. So the answer to your question is, change of mentality. We're negotiating a bigger office now as well in the same block, and looking for the right people. We've had a couple of people start. We've had a couple of people leave. Why
do you think they leave? What was the
why?
Was it because they weren't the right people, or because it's either, when I look at it, is sometimes I've got an absolute cracking story. Actually, I was thinking about it on the way over. Right, you got to look at yourself as I've obviously interviewed someone, I've misread that person, and I've got it wrong. Right, so you have to put your hand up. And then, we'll come back on a story, but this one was in the early days of Arc & Co. And I took this guy, it's probably 2011, 2012 time. And so I went through the interview process, probably not as diligent as I should have done. And within the first 2 hours, he said, I really don't understand your business model. Your business is going to fail. It's not going to work. Right, we're in 2 hours of starting the job. So I thought, all right, well, let's call it quits now. So he left straight away. And they said there's nothing but a free lunch, but I ate his sandwiches and his crisps off his desk.
Following on.
There is a story about a free lunch, but I made a mistake on the recruitment. But
following on with that, I've got exactly the same sort of thing. So I had a guy last year, picked up a deal. It was for a large industrial laundry shed that supplies restaurants and hotels in central London. So I call him up and say, look, it's a couple of £1 million. Can you put it to, the standard structured market? He calls me back in a panic about 10 minutes later and said, oh, Matthew, guess what? And I'm like, what? I've just been on the FCA website. It's regulated. And I'm like, hang on a minute. An industrial laundry unit is not regulated. He's like, no. He owns it in his own name. It's definitely regulated. I can't touch it. And I'm giving you a £2.5 million deal at 40% loan to value. If you don't want to do that, then I think the door's over there, really. And he was adamant. We had a row over it. And I actually double-checked. I was going to call you, actually. I double-checked with Jeremy. I said, can you just tell me, is this a regulated deal or not? And obviously it's not. And after that, really, the writing's on the wall. Because going back to my point about having a bit of, just something in between your ears. Look at a deal. I'm going to take it forward. Don't Google the FCA website and realise that it's.
If you interviewed someone, do you think you would know straight away, or how do you think if they're going to be good?
So I've interviewed quite a few people in my time, and it's all about. It's all about working with them, unfortunately. I mean, I don't know. You can tell me. You can tell me more. You've had more people. Than
reverse the question back on me.
Yeah. Can you spot it in an interview or not?
I tell you, the most important thing to me is try and see if that person can be natural, right, in an environment. Right? So, finance I can teach, or we can train them and do whatever, right? But getting them to be their own person, right, is a really, really important thing. So I always say, if you can be the same person you are that side of the door as you this side of the door, then I want you. right? Because you're not a fraud. You're there. You can work with those people that are more genuine.
Authenticity.
Yeah, and you can get there. So the authenticity is a great word, and didn't think of that one. But it's good. But that's if you've got to get authentic people, right? Because then you can work through anything with them. The drive, you can kind of pick up on things, but that comes with it. But the authenticity, I think as a broker, you've got to be very personal. We spoke earlier on about relationships and that lot. Sales, relationships, it's all about relationships. So if you can't have conversations with people, well, forget about it. You may as well, you're not in the right side of the team. You may as well be an analyst or something. You've got to be able to engage with people. So you can't, there's no point sitting there and say, list me off your black book, list me off the deals. That's rubbish. It's how are they coming across? And then we actually get them to do a business plan now, which I didn't used to do, which is a good thing because it kind of sets things that we think we want to achieve in the first 6 or 12 months. So that's the kind of final part. But I think it's more about how you can identify these people. Are they authentic? And the other thing, quite often they change when they go out of the office. It could be in the pub, it could be anywhere. And our industry is quite sociable. Right, you got to be. You got to have good friends on the lending side. You got to have good friends with your clients. A lot of our good clients, we go to their weddings, christenings, or whatever it would be. And if they can't behave themselves or be normal in those environments, well, it's not going to happen. So I more look at the personal traits, and then everything else can be built in.
Yeah, I don't disagree. I think it doesn't necessarily have to be through the industry where you bring them on board, but I think being an advisor on the structured side is very much about the individual as opposed to professional experience.
It's also what they want to achieve, right? And so we've been going for 17 years now, so we've had quite a few cycles of people. And some people, one of the guys in the team actually said the other day, you've trained a lot to market, and I think you made the comment on me last time. And you can either sit there and take that as either a compliment or kind of a threat. I think it's actually, this is probably with age now. I used to think, oh, why am I losing people? And people will move on. Right, and Matt went and set his own business up, and that's all great. Some people want to do what Matt's done. Some people want to be part of a business and grow within it, and then that comes back to, have you got the right business set up? Are you allowing them to grow? No doubt they want a piece of something. So are you going to give them some share incentives or whatever we do? So I think recruiting people is very tough in our sector. You got to concentrate on the person. You got to see, you will lose some because they go and set up their own business, and that's perfectly fine. Or if they stay with you, have you got the right business? There's more emphasis on us as business owners to give them the right platform to excel. And that goes back to what we talked about at the start, the professionalism of the advisory brokerage businesses. And so they are proper businesses now.
Yeah, I've got a couple of questions still left, but I think the follow on from that is, you're obviously still got many more years in the industry should you wish to continue to do it, but obviously life gets more complicated, as we were talking about. My role as a full-time taxi driver and part-time business owner and founder. How do businesses like yours though go about monetizing them in terms of, at some point you're going to want to have some form of exit. How do you and at the moment they're still, in my opinion, brokerages are undervalued. How do you think brokerages in the future will be able to sort of capture more value, more capital value in there?
Well, first of all, there's some great examples of businesses like ours which have sold, right? So precedents have been set within it. Matt is on an early stage of it, but what you learn is really about the structure and the setup you have, right? So there's when I first started Arc & Co, it wasn't about me taking 100p in the pound on a deal. It was about, I wanted to create a company of value. And there's not many people that have that, because most people leave other brokerages and they want more pennies in the pound, which I get and I understand. But if you can build a business of value, show them the plan. So you've got to have a good ecosystem around it. So you got to have good partnerships that refer you deals in. So you've got to have which you can show repeat. You got to have good structure, right, where they can progress, and you can show. You got to have a good balance of the team. You know, they right as trainees at certain levels, and so you got to have the right balance of all of that. You've got to actually have scale. So I've actually been asked this question a few times in the last few months by some of my ex-colleagues or friends that I've known in the industry for ages, where some people were there are 2 or 3 people within their team, and they're talking about their business value or whatever you said. I said, look, there's no point doing it unless you're minimum of 10 people, right? Because you've got, what are you? You're a couple of people, and no one's going to buy that. Right, so you've got to have a bit of scale, and that's hard to get. And it's I find it. We're at 18 now, and we go largest have been is 25, and it's a constant. You got to work at it all the time to be doing that. So it's not easy to do that. Otherwise, you're kind of a branded person taking 100p in the pound. Or there was one broker I actually said, "Are you going to build a team?" And he said, no, I've been talk crude on numbers, I'll not say his name, but he said, last year I earned £600,000 and I don't have a headache of a team or people, so why do I need it? And that's what his interest was, right? Which is great. But if you're going to build a team, you have to have the right structure, is what your question is. You need to be quite not unselfish is what I'm trying to say. What's the word for that?
Generous. Generous.
I think unselfish is the right word, actually.
Yeah. Because with myself, as Matt knows, I don't do many of the deals. Hopefully I try. My challenge is to try and keep into the market so I can challenge the people I work with, because otherwise you lose a bit of rapport and value with them. But you've got to, you as a business owner comes second, right? So the business and the team comes first with it. And the argument I've always had with people is your business is worthless because it's just the people, right? And a lot of businesses are the same like that. I've always argued, obviously, that is different. So I've always put a lot of value and investment into the brand. Now, if you invest in Arc & Co, I think, is quite a well-known name in the sector now. And it attracts things. It's easier to recruit, right? Because people want to come and join you because of your past successes and what you stand for, and so you have a lot of value within that brand. So that takes time. We've been doing it 17 years, right? And so that can't happen overnight. So I honestly believe it's good you think they're undervalued. So I'll come to you and see what.
Yeah, I was going to ask you the same about that, actually.
But I just think there is a lot of value within them, but you've got to have the right business structure internally. You've got to have the right support around it. I think you said earlier, Matt, you're talking about partnerships and partnership. It's the right approach. I will say a name, someone that did it very well, but Danny Waters did it very well with the Enra Group, not just because of the lending side, which people know him mainly for, but more he started from the brokerage side, and he actually bought Enterprise very cheaply. I think it was £1. I don't know if you quote me on that, back in the global financial crisis. But the value he saw was the contracts he had with the networks. He was contracted with networks up to 5 years, right? So the big mortgage networks used to refer stuff, or still do, into his brokerage, and they carry a lot of weight. Right, so you can build partnerships with, we've spoken about agencies earlier on, any partnerships which you can produce repeat business, add good value.
Yeah, and then just in terms of building brand, I mean, certainly, I think certainly people would definitely agree that Arc is considered as, I suppose, a premium brand in the specialist finance brokerage market or advisory market. Matt, you're obviously building a similar brand with Aquilae. I suppose in this sort of in the congested marketplace that capital advisory is right now, how do you go about standing out? How do you put yourself at the front of the queue? I'm sure something like this is probably not doing you any harm, but
go on a podcast with Robbo. No, I mean, look, we're not finding it hard. One thing we've never been short of is business, and that's since we opened our doors about 3 years ago. And Andrew's right, it does take time to build a business, which is why we've taken it quite slow. We wanted to get the foundations right. We've got our CRM in place, we've got the admin there, we've got some generation, we've got somebody down in Brighton. So we're kind of creating the suite for brokers to come into. We could have hired earlier in the year or after the previous podcast, but the time wasn't right. Now the time is becoming right because everything is in place. So if somebody walks through the door tomorrow, let's say, I can give them a laptop, a phone, I can give them the logins to their own CRM under the Aquilae brand. Everything will be logged on, all the emails will be tracked, all the lenders that we work with, family offices, private funds, whatever, they've got access to on the internal systems. It's a cockpit for a broker who knows what they're doing. For somebody who's coming into the industry, there's a seat next to me or Jeremy or one of the other guys in the office, and we'd happily talk you through the academy side and bring you up to scratch, depending on which way we go. And that first person walking through the door, depending on their experience, we've got the right offer for them, and that's why it's taken us just under 3 years to get to this point. But to be honest, that's how I wanted it. I never wanted a quick sort of takeoff. I didn't even announce that we started the business when we started it, because I said to Jeremy, we're not going to tell anybody on LinkedIn or in the industry until we've actually done a deal. And so we only announced the company when we closed our first deal, because I'm very much under the philosophy of, I don't put, we've got terms for £100 million on LinkedIn. I don't put my email or my phone number on LinkedIn, or I don't ask for any business. We want to be about actual, content, real things that have happened at Aquilae. This is what we've done. This is what we're going to do, and this is how we've done it. And that for me differentiates my business to most of the market. I know Andrew does it very similarly. So most of the market tell us all these great things, instruction, valuation instructed, or set of terms or whatever. We only announce things when we've done them, and we do things very, very slowly. And I'd even go to say, LinkedIn keeps asking me to ask for followers or ask for likes. I don't do any of that. I want pure organic growth. And it's a hard way to climb the mountain, but when you're at the top of that mountain, you'll realise why. That for me, that's one thing that I don't want any shortcuts, any easy sort of roads. I want to do it the very, very hard way, because I think once you've done it the hard way, you've built a solid foundation, and you should be able to thrive. And then once you've got the systems that Andrew was talking about in place and the right staff, then you can talk about potentially selling or bringing on equity partners and things like that.
How do you take yourself away from the coalface, though, in terms of working on the business versus in the business? Because I guess that's kind of the position Andrew's now got himself into. You're still in that.
I don't think Robbo's ever done any deals, has he?
Well, that's my challenge. I'm head of admin. I just love doing admin and compliance, and, making sure they can still broke. So,
that'd be difficult. And I'm sure I'm going to go for lunch with Robbo to talk about moving the business forward, because we're colleagues. We don't compete against each other. If there's a deal that we're both on it, I'm sure we're big enough and old enough to be able to pick the phone up and have a discussion. But it's important to look at everybody in the industry as colleagues, because I think that's the only way the industry will move forward in a positive way, rather than we're all against each other. Because yes, there will be a bit of competitiveness, of course, that just comes with the territory, but over that competitiveness there should be a level of respect, and I think we've got that between ourselves and our businesses.
I think even amongst lenders we collaborate, right? Which is everyone has their own individual strengths, everyone has their niches that they operate towards, and I think a lot of people from outside the industry, specialist finance industry, would be amazed that people that compete have such close relationships or have such close bonds. At the end of the day, we all bring each other up together, don't we?
There has to be a kind of unwritten rule, right? With we spoke about it on the first podcast where you said about deal sharing. Matt knows this. I'm not a big fan of deal sharing in the market, and I love competition. It doesn't have to be aggressive or untoward or whatever it would be. It can be direct. But there's no point to me. It's like, let's work on this deal together. Let's share. Generally, it doesn't work out well in my experience. There's people who think either someone's originated it and someone does it. So someone thinks that they're worth more than the other person. So then you got a fee issue split. Because it's very granular, we're talking deal by deal here, not on the partnership bit. And usually what happens is the fees get pushed up for the client. And so the client comes worse off. So it's not, I haven't had a great experience on broker-to-broker collaboration on a granular individual level. So you won't find us doing much of that from it. And if Matt, like he said before, said, if we work, sometimes we do come across these. We haven't actually, I don't think, come across each other on a deal yet. But in my mind, it's fair game. He will know who we're probably talking to anyway. But as long as we're not doing anything to backstab him to the client or whatever it would be, then that's great. But to me, it's best advisor wins, right? And that's the way it should be. And that comes down to maybe my kind of personality or I love sport or whatever. And I think that kind of comes through is you should want to win it, right? And if you got that trait, that's not bad.
It certainly helps. How do you feel about clients running around with multiple advisors or brokers though on a particular case?
Me or
both of you?
Well, we'll probably give the same answer.
Go for it.
It's not good, but I think I spoke earlier on about saying how the market is in a big shift, and because of sourcing systems. So from the mortgage market, obviously at 27 Tech or whatever they have to source all the products, you go online, you got to compare the meerkats and all this kind of stuff. It's working its way into bridging and development. So the debt market's becoming very visible, right? So automatically what you get, and we're seeing more of it now, you get your little widgets on your website and people go on there just to get rates, clients from it. And then they go on a competitor's website and get another rate or whatever. So suddenly they're already shopping. Ultimately, I don't have much respect for that. They have as long as they've got to make sure they're dealing with the right company, right? And so if I'm not saying Arkenco always gets it right, no one is perfect, but you got to drive to make sure you're giving the right advice on it. And if they don't respect what we're doing or what we're structuring, then it's not the right partnership. Right, go and work with someone else because it's not the right dynamic. I don't want to work with them. When you're doing a specialist finance transaction, you form a bond with your client, and if that bond's not there, what's the point? And so that's how I think.
Yeah, I totally agree. I think if somebody's shopping around, they're more than welcome to shop around. But ultimately, you are going to go on a journey with that client, and if you can't sit in the same boat while you're both rowing, then you're going to have trouble getting on to the other side.
Well, also, if they try and chip your feed, how many crumbs left on the table?
There's no crumbs left on the table. I think it's an element of respect, and also as an advisor, you might need to control them a little bit. I mean, tell them, speak to other brokers, be transparent, let me know what you're getting, and then kind of close that conversation. If they're continually shopping, then I'd probably walk away like Andrew. It's not something that I'd want to be involved in.
They have to want to deal with you as a stuff. There has to be a two-way relationship there. If they don't want to deal with you, then what's the point of dealing with them? It's if you're doing the right job, it's the right product, it's the right advice. We believe that. They need to buy into it.
Yeah, and also remember, a good structured finance advisor, let's say, should be doing about 30 to 50 million pounds of business a year, at roughly 1%, 300 grand of commissions, let's say. Now, you don't need 100 clients for that. Okay, remember, you only need really 6 or 7 active clients. 3 active 1 year, 4 active another. And if they're doing good business, then really that's all you need. You don't need like agency where you get 100 leads on a Monday and let's go through these leads and find a good deal. If you're a good advisor and you've been in the industry for 10, 15 years, the most advisors that I know that have been in the industry that long have got a set of clients. And those clients are 5, 4, 6, And they will feed that broker the 600,000 or the 500,000 pounds worth of commission. And that's very important, because if you take too much on your plate, you start losing your relationship with the clients. You don't build the foundation of what you should be doing the other way around. And that's quite an important point that brokers should understand, that you don't need 100 clients. You only need 6 or 7 good ones, and then a few walk-ins through the year, and you'll hit your 250, 300, if not more.
Yeah. And I suppose last serious question anyway is that, do you think that there are now too many lenders in the market? Could you do with some consolidation of the lending market from the broker's perspective?
I think you've got to look at, there's loads of lenders out there, but first of all, who's lending? Right, so are they all lending is a question.
Because you talked about the shrinking of the development side of the market, but maybe more people going into bridging and stuff like that.
I actually like it, right? So
I do as well.
I think it's competition is good for the end client consumer with it, and keeps us on our toes. It's a nightmare. We did 208 deals last year, 83 different lenders. It's a massive USP for us, right? So it's a good sales point, because we can go out and promote that and use that to the clients. But it's tough for us to keep on top of that. But ultimately, it drives better deals for the customer. So maybe there might be some consolidation. I think there probably will be, because distribution is key, and you have to have a scale in the lending business, and they can't get all to a certain scale. So there definitely will be. But I think the mass choice of be it bridges, development, commercial lenders, I think is really healthy for the market.
Yeah, I agree. It keeps advisors on their toes. I think it creates good competition, and really, they're all flooded with one funding line anyway. So once you know, once you know the criteria, you can go to any of them. No, I think it's healthy. There's nothing wrong with that. The problem by having a few statutory lenders in a marketplace would mean that the advisor gets lazy. Whereas if you've got new people coming in all the time, albeit with the same funding lines or not, it's good for us. It's a fresh name, it's a fresh approach. It also keeps everybody else on their toes. So I don't think that's a bad thing at all. There will be some consolidation. That's evident, because the business, has streamlined itself a little bit. But we'll see who's left standing, I guess.
Yeah, I think the next few years are going to be quite interesting, just both in terms of consolidation, but also I think that there will be. Yeah, I think the environment is challenging. The point you make about being able to feed the machine, the lending machine. I think we'll see a lot of people operating in that kind of mid space. Maybe their business models will either have to adapt or die. We talked about the development finance market. I think the bridging market is so cutthroat in terms of if you want something that's kind of vanilla bridging, the pricing is so cutthroat that I think a lot of people just haven't got the funding to do that. But then they also haven't got the funding to do the more asset management heavy refurbishment developments and stuff like that. It's going to be pretty fascinating from an outsider's perspective anyway.
I think it's actually becoming an advisor market rather than a lender market.
Has it not been that for the last?
It's been a credit market for the last 2 years.
Well, it's more. Well, that's because they say about the fee. The problem with the brokerage market, advisor market, is it's one-off fees, right?
Yeah.
And so I remember being on the call in COVID, and there's something I know we're going to finish soon, but I want to say one story about when we used to work together in COVID, which is an absolute cracker. But we still talk about it in the office. But the thing, you think he knows what's going to happen. We did talk about that one, so I lost my train of thought.
Yeah, I'm trying to lose your train.
I remember someone said to me from a lender point of view is it's good we're on the lending side in COVID, because you got the renewal income coming through, where we really suffered on the advisor side, because it was hard to get the fees in when you get paid on that. But on that note, there's a cracker one where we're all working at home, and so we got all of the team on a Teams call. And I think you could we weren't complete lockdown, so you could go some places, whatever. So we're having a team update, and Matt's on there, and his wife comes through the door shouting at him. So Matt goes from
you're on the way to Cornwall.
Yeah, he's on the road, get out now, in the car, like this. And, and you can see his face, like that, and the laptop go down. And the whole team at Ark & Co was laughing their head off, because Matt just been given his orders, get out. So we know who wears the trousers in his relationship.
That was revealing, wasn't it?
Yeah, exactly. We didn't let you down on that one.
No, No, you didn't. You didn't.
Speaking of trousers, a good segue to finish off. We're both Matt and I were remarking, Andrew, on your svelte appearance. Obviously, needing to have your trousers taken in.
I was wondering where you're going with that, Michael.
Not trousers down. I've had that a few times before. I've had my pants pulled down in this industry. I can tell you that.
A few times. Yeah, probably by Avamore.
Yeah, it's safer to wear braces.
But no, you've got into some pretty good shape of late. What's the secret?
Well, I think it's basics. You've got to do some exercise. I think, look, how everyone goes on about the health and whatever. We are in that kind of dynamic, of the world. People taking care of themselves a lot more. I'm not saying I'm the leader of that, but when you get to mid-40s and you've got a young family, you've got young kids as well, and you work as hard as we all do, you get knackered. And I actually find exercise helps it. So even though it's not a lot, and they take the mick out of me in the office because I do 20 minutes in the morning.
Is it all the 6 o'clock runs still?
At 6 a.m. I just do 20 minutes. It's the same routine.
Is it the same one, yeah?
Also, I'm not having bacon sandwiches in the morning.
Because your office is nowhere near a bacon sandwich place.
Yeah, exactly. But thank you for the compliment. But I haven't made it to Turkey yet to get the implants. But
I'll be right behind you on that.
You've actually got more.
No, don't worry. Actually, I've styled it well today.
You went to the wig shop on the way in.
Right. Well, I think on that bombshell, we'll have to end it there. But it's been brilliant fun, guys. Thank you so much for coming in.
Appreciate it.
Andrew, I know we'll ask you where people can find you. Matthew doesn't want anyone reaching out and offering him any business, so we won't give him that invitation. But no, joking aside, if people want to get hold of you on the internet, Matthew, where can people find you and how can they reach out?
AquilaeCapital.com.
Aquilae Capital, okay.
Or on LinkedIn, or right next to Andrew.
Right next to Andrew, yeah. And Andrew, what's the best way for people to reach out if they want to get hold of you?
Anywhere they want to, but website, email, LinkedIn. I love, not like Matthew, I love LinkedIn. I've got about 17,000 followers now.
How much did you pay for that?
That's corporate value. I'm selling my contact base.
That
was the offer from last month, wasn't it?
Well, Ed's got about 500, but they're mainly his mates from the gym.
Fair enough. Well, I've been Michael Dean. You can find me on the internet at property_funder. Many thanks, as always, to Avamore Capital for their continued support. Thanks to the lovely Davina for organising today. And we'll talk to you again on the next one. Thank you and bye-bye.